All right, how to turn your home equity into a monthly cash flow. That is what today's video is all about. In this video, I will be walking you through step by step how to convert your equity you currently have in your home into a monthly mailbox money. So if you're ready, I'm ready. Let's get to it. So this is you right now. You probably have about 30% or more equity in your primary residence and you don't know what to do about it. Number two, maybe you own some single family homes or single family rentals that you are probably not taking good advantage of. Number three, maybe you love to invest in real estate, but you just don't know how. You don't have the money. You don't know how to do it. So I will be walking you through it step by step how you can maximize that money you currently have. Number four is that you have a paid off home. Maybe your home is 100% paid off or 70% paid off, but you are still don't have a clear action plan for how you're going to retire, and that is what I'm going to be walking you through in this video. Now, number five is maybe you have a business, you are a successful business owner or successful entrepreneur, but you still don't know how to invest in real estate, but you have the asset that you can leverage. So if you fall in this category, this video is for you and I will walk you through it step by step. Now, before I continue, I need to give you a quick warning. Now, if you have the money in your home or in your business, it does not mean you have to use it, right? So if you don't have the right education, I put it here, proper help to using the money, please don't use it. It is better to allow that money sit in your home as an home equity than to use it the wrong way. If you want to get my help, I'm always available to help you. You can find all my contact information in the description below and I'll be able to help you out. Now, also a reminder is that most people will think because they have a paid off home, oh, my home is paid off, I have zero mortgage on my home. Does not mean you still don't have a monthly expenses. You have property taxes, you have homeowner insurance, you have, if you're a landlord, you have landlord insurance, right? So these are the expenses, maintenance, utilities, landscaping, among other things that you're still paying money on, even though your home is paid off. So don't get into the misconception that if you have a paid off home, you don't have any expenses. So how can you do that? How can you use the home equity you've acquired over the years? Maybe you've owned your home for 10 years, you've owned your home for 5 years, you've acquired some equity. Maybe you bought your home in 2019, 2020, and now the value went up in 2021, 2022, and you have been thinking, how can I actually tap into that money and use it to invest in real estate so I can be getting a monthly cash flow? That is what I'm going to explain to you here. But what is home equity? Some people don't even know what home equity is. Home equity is a difference between the market value being the keyword, and your mortgage balance. So let's say in this example I have here, your home market value is $650,000, right? $650,000 right here. And your mortgage balance is $250,000. Now, if you subtract $250,000, your mortgage balance from your home equity, home value, that means your equity is $350,000 right here. So you can easily see that $650,000 minus $250,000 will give you $350,000 home equity. That is what home equity is all about. That means you have $350,000 as home equity. Now, you can now go to the bank and get, typically they will do up to 75% of that value. So in this example, we have $350,000, right? Multiply by 75%. That will give you this, what I call available to you, available cash, will be $262,500. And that is the money you can use to now invest in real estate. And I will show you how to do that. Now, this is 5 major ways how you can actually get that money out of your home and use it to invest in real estate. The 5 major ways are: number 1, you can do what most people know as as HELOC, home equity line of credit. Again, home equity. If you don't have any equity in your home, this is probably not for you because you need to have something to leverage on. So home equity line of credit, most banks will do that for you. And again, they can go up to 75% of the available equity you have in your home. This number 2 way is home equity loan or e-loan. E-loan means home equity loan, right? So instead of getting a line of credit, you can actually get a loan. Now, the loan is that all the money is available to you right away, similar to the HELOC, which is home equity line of credit, but the loan is that you start paying off monthly payments on that loan. But the advantage for the HELOC is that it's a line of credit. If you don't use it, you don't have to pay any interest on that money. But for the loan, immediately the money hits your bank account, you start paying the interest on it. That's just the two major difference. Now, number 3 is you can do a cash out refinance right here. You can do a cash out refi. Cash out refi simply means, hey, you know what? I just want to get money out of my house. I will refinance. Now you are getting a new loan. You are getting a new loan, but in this number 1 and 2, you are not getting a new loan. Your mortgage still remains the same. You're just getting like a second loan on your property. Your original loan still remains the same. Let's say you have 3.25 interest rate on your property, right? So instead of you do a cash out refi, you can do either of these number 1 or 2 option, which by the way, this seems to be the most common approach a lot of people take. So you still keep your original loan, but you have a second loan on your house and you are paying interest. You continue to pay the mortgage on your primary home, on your primary loan, which is your first mortgage you have, and on the second, on the HELOC or the HE-loan, if you withdraw the money from the HELOC, you start paying interest on that one as well, or start making monthly payments, which is always the principal and the interest. Or if you do E-loan, you're doing the same thing. So just kind of know the difference between two. So why should you cash out refinance? This is least favorable option in my opinion, because if you really have a low interest rate and you qualify for number 1 and 2, why should you go and refinance out of a low interest rate and get 6.5 or 7.5% interest rate? But there could be some situation where you really need that money and maybe you just don't qualify for number 1 and 2, then you can still do the cash out refinance, to still purchase that investment property. So number 4, you can actually sell your home outrightly. Now, if you sell your home, this could be your primary residence or it could be an investment property. You can sell the home. Now, how you do this is very simple. You're going to hire a real estate professional, a realtor, a real estate agent, or real estate broker to help you sell your home. Now, I do advise you explore the option 1, 2 first. If you don't qualify, you go to option number 3. If you don't qualify, that's when you go to option number 4. Now, you sell your home and whatever proceed you get from there, you can use that as a down payment to buy that your rental property. I will even walk you through a real life example in this video. So here is how you do that. You hire a realtor and they'll help you put your house on the market. They will advise you what it will sell for, among other things, and you go from there. Now, if you want to get a realtor from your local market, comment the word realtor in the comment section below and I will connect you with a rockstar investor agent in your markets. Now, number 5 is 1031 exchange. Actually, this is only applicable to an investment properties only. If let's say you have 3 or 4 single family homes, right? Now you can sell those 3 or 4 simultaneously at the same time, right? Now that money, once you sell them, now when I say simultaneously, it could be one could close this week, another one could close next week, another one could close, 3 weeks later. But almost the same time that you are selling them. So all that money will go to the title company, or they call them 1031 exchange custodian. So that money will sit in the escrow account and you have 45 days to identify a property you want to buy and you have 180 days to close on that property. So in this example, you can sell your 3 single family homes and let's say when you pay off the mortgage, you pay off all the whatever debt you have on it, you have $500,000 left. That $500,000 is now what you can use to go and invest in real estate without paying any capital gain taxes on it. This is very, very important. This is why a lot of my clients do this. You do not pay any capital gain property taxes on it because you are deferring the taxes maybe, down the line. You defy. We pretty much call it you're kicking down the can, down the road. You're kicking down the can. So that is what it's all about. Now, let's use this example I've been using, right? So you have a property that is valued at $650,000. Your mortgage balance is $250,000. And if you subtract, 250 from 650, your balance is what? Your home equity is now what? $350,000 right here. So the bank will now use up to 75%. That is what they will do. So they will give you 75% of this money. And that is what you can now use as your down payment to buy that rental property. So if you're following me so far, you kind of get it up to this point. Now I want to walk you through the step-by-step how you can actually do this according to your own situation. Now, I call it the roadmap. You can follow this roadmap. Now, you can add some things to it if you think your situation calls for it. Maybe you need to repair your credit first before you can apply and all those things. But this is the very common step I've helped people to actually follow. Now, the step one is that you need to get educated, right? You don't want to, like I said at the beginning, because you have access to that money does not mean you actually have to use it. You want to get educated, and how you do that is I have videos on my channel. I will link it in the description below. That I call it step by step, how to invest in real estate step by step. I'm assuming this is your first time doing this, or you have little to no education. If you are a very experienced investor, you probably already have the education to use this money wisely. But if you're new, please don't use that money if you don't have the proper education. That's step one. Step two is that you need to now decide what property type you want to go after. And I do recommend you pick just one property type. So you pick that property type and you're going to master, being the keyword here, you're going to master the property type. For example, let's say you want to do multifamily, maybe you want to buy like a 10 unit or 20 unit apartment complex. You need to master that real estate investing strategy and the niche of that investment so that way you don't lose your hard-earned equity in your home. Now, for example, or you want to do a single family home, you need to know how single family works. How much is it going to rent for? Do the research on the neighborhood, on the location, on the price, what is driving the economy in that market, among other things that you need to know before you invest in any property. So again, this video that I talk about here will really, really help you. You will find it in the description below, or you can actually watch it here. Now, talking about that, there are so many real estate investment niche and that you can do. And in my experience, I've been doing this for a couple of years now. I don't know any successful real estate investor that is doing everything. They always specialize in one aspect of real estate. They spend so many years and a lot of time mastering that niche before they branch out to other real estate investment strategies. So I encourage you to do the same. Don't try to implement 3 or 4 strategies simultaneously. I can guarantee you it is a recipe for disaster. Now, if you say you don't like single family, you can do self-storage, you can do mobile home park, you can even do a triple net deal, those your, Dollar General, those Walgreens you see, they are triple net deals. You can even do a flex space, among other things that you can do, but please, again, pick one strategy for at least 2 years. Stick to that strategy for at least 2 years. Once you master that, you can continue to move on to more complicated or more advanced strategies. Number 3 is that you want to make sure you hire an investor agent. So this is very, very key. Investor agent. Real estate agent and real estate broker are not the same. They have different area of specialization. So let's say you want to buy a single family home or a multifamily. Your job is to go and do a research on which market you want to invest first. Once you decide on the market, then you can now go after and do the research on how do I find the best real estate broker or real estate agent in that market that is focusing on my real estate strategy. For example, multifamily. If they don't do multifamily, then you probably will not have a good experience working with them because they may not know how to really help you. So pick the property, then go after the real estate investor agent, being the keyword that can help you implement that strategy successfully and help you make smart investment decision. Now, agents are not made the same. Some agents are just focusing on luxury home. Some are just doing, regular home buyers or home sellers. They really don't know about investment. So it's really, really important you make sure that agents have experience working with investors, especially if they're even investors themselves. Now, you can watch my video here that I call On Fire Agents. On Fire Agents. So this is an acronym that I pretty much summarize on what you should look for when it comes to hiring an investor agent that will be working with you. On Fire means they are organized, they are well networked, they are, focusing on you and keeping you focused. They are investor themselves. That's the I, and the R means they are very responsive on the phone. They answer their call, and E means they are experienced in that strategy that you want to implement. Again, if you want to watch that video, I strongly recommend it. You will find it in the description below. Now, you also want to, number 4, you want to make sure that you get comfortable analyzing potential deals. Again, analyzing potential deals. So there is really no way for you to make a decision if you are not comfortable with the numbers, because a lot of people that I talk to that are very new, they end up not doing anything because they are confused and they just don't know how to analyze property. Now, even though they get some help, some of them still allow their fear to stop them. So I don't want that to be you. How you can combat that and avoid that pitfall for a lot of new investors is to get comfortable analyzing deals. If you get comfortable analyzing deal, which you can get my calculator on how to analyze property, if you comment the word CALC, like CALC, CALC, and I will send it to you. CALC, CALC, and I will send it to you. So make sure you subscribe to the channel and comment the word CALC, and I will send it to you. So if you get comfortable analyzing property, that will make decision making so easy, because if the number tell you, hey, this is a deal you should pursue, obviously you're going to pursue it. And if the number say, hey, that's a deal that will be losing money every month, you don't want to buy it, then obviously you're not going to buy it, right? So let's make sure that you get comfortable analyzing it. That's number 4. Number 5 is now you have to start making offers. Number 5, you have to start making offer, because nothing is going to happen if you read all the books you can find on real estate for the next 2 to 3 years. You will still not achieve anything. If you listen to all the podcasts available, you will still not do anything until you actually take action to analyze deal and submit an offer. When you submit an offer, that is when you start playing the game. And if you don't play, you cannot win. So when you play, now you are increasing your chances of actually closing on that property. Number 6, which is what I call your due diligence. You want to do a due diligence on that property. I'm assuming you made an offer on number 5 and your offer was accepted. Then you start doing your due diligence and eventually get that property closed. Now, because you put a property under contract does not mean you have to buy it. If during your due diligence you found some issue, maybe there is a foundation problem, maybe the financial just doesn't add up to what was advertised, or maybe you just don't feel comfortable with the neighborhood or the overall investment anymore, you can pull out, terminate the contract, and you're going to get your earnest money deposit back. Again, if you want to get recommendation for a rockstar investor agent that can help you in your market, comment the word agent in the comment section below, and I will make that recommendation between you and that agent. Now, if you're in the Houston or in the Texas market, I'm always available to help you as well. So don't be shy, reach out to me and I would love to help you. Now, we're going to get into a real life example right now. This is what I put together. This is a very realistic example and I will walk you through it step by step, how you can actually do this based on your own situation, not on somebody else's situation, based on your situation. Now, I'm using this example. You can easily replace your own numbers. Let's say your home value is $400,000. Your home value is $2 million, whatever the case may be for you, just replace this number and you should be fine. So in this example, I'll be using how to actually convert that home equity, right, into a monthly cash flow. That's the topic of this video, right? So I'm using a 10-unit multifamily apartment in Houston, Texas, for example. Now, you buy this property for $1 million, and because if you remember this example here, right, we already have these numbers. The home value is $650, mortgage balance is $250. When you subtract that gives you $350. Out of the $350, you can only get 75% of that money, right? This right here. And this gives you what? This gives you that $262,500, which you can now use as your down payment. You use that out of the $262,500, you use $250,000 right here as your down payment, and you can use it $12,500 as your closing cost, because when you're buying property, there are two major form of payments you made: your down payment and your closing cost. So this is how you can use it. Now, if this $12,500 is too small for your closing cost, your investor agent can always negotiate some closing costs for you with the seller. That is what I do for a living, and I can help you as well. Now, this example, we are buying a 10-unit apartment complex in Houston, Texas. We're buying it for $1 million, and that means we are buying, each unit is what? $100,000, right? This property will rent for $1,000 per unit, and 1,000 times 10, that gives us $10,000 monthly gross income, gross. Now, based on that, we will now multiply by 12 to get our annual income of $120,000 per year. Now, you don't keep all the money, as you know. If you are experienced or even if you're new, there will be vacancy. So industry standard is around 5%. If your property is in a decent location and is well maintained, you should be able to maintain 5% or less. So let's go with the highest. We'll say 5%. So 5% now, if you take away 5% from the $120,000 annual, that's, multiply 0.95 by 120,000, and that gives me $114,000. So all I'm trying to achieve is I'm trying to achieve my NOI, which is my net operating income, right? So what I would do is that I would also now subtract the annual expenses. Now, industry standard is about 35% of your monthly income or your annual income is typically your expenses. So this is excluding your mortgage payment and also excluding vacancy, as you can see here, right? So now $35,000 per unit, because each unit is bringing in $10,000 per year, right? So if you multiply by 35%, that would be $3,500 per unit. So that gives us $35,000, right? So $35,000. Once we get at $35,000, we subtract that from the amounts left. The income is $120,000 per year. You subtract 5% of vacancy, give us $114,000, right? From there, we subtract annual expenses. Annual, this is not monthly. Annual expenses of $35,000, and you see right here, and that gives us $79,000. So your NOI, which stands for net operating income, is $79,000. So we are not done. We have to now subtract our mortgage. How do we do that? We are assuming that you were able to get a good deal on your mortgage and you got 7% interest rate. So you will now go here and subtract your 7% of your loan amount, which is $750,000, because again, you remember we're buying a property of $1 million, right? And we are putting down $250,000. So that means our loan is what? $750,000 right here. $750,000 is our loan, right? And your down payment, which is the money you got out of your home, is $250,000. So what we do now is that we subtract that. When you do your calculation, you can use multiple online calculators on how to get 7% of a $750,000. Should be giving you around $52,000 per year. So also, you have to remember this. You borrow the money from your HELOC, right? You use your home equity line of credit to buy it. Now, that's where you got your $250,000 for, right? There will be monthly payment on that money. So you do not want to skip that. You don't want to miss that. You want to make sure you factor it into your calculation, so that way you know exactly what your number will be at the end of the month. So we are trying to achieve what is your cash flow, right? Because that is the whole subject, of discussion in this video. How do you get cash flow? How do you convert that lazy equity of $350,000 in your home? How do you convert it to a mailbox money? How do you convert it to a monthly cash flow? That's what I'm discussing here, right? So you subtract, let's say in this case now you got HELOC, which is home equity line of credit, and your interest rate is 5% right here. So this 5%, which comes to about $1,100, actually about $1,092 or so, but 1,100 times 12, that gives us $13,000 per year, right? $13,000 per year. You now go back to your NOI, which is $79,000. If you remember this one, NOI, that week, $79,000 minus, you subtract $52,000 right here. Then you also subtract the $13,200 for your HELOC payments. This is your mortgage, and this is your HELOC payment. that I mentioned above right here, this and this. So that will give us $13,800 as your annual cash flow. $13,800 per year as annual cash flow, right? Now, if you divide that by 12, it will give you a monthly cash flow of $1,150 per month. This is how you now get that $1,150 in your bank account every single month, or you get it as a mailbox. Sometimes we call it a mailbox money right here, mailbox money. So this is how you can convert that lazy equity, that equity that is good for nothing in your home, and convert it to a monthly paycheck, monthly mailbox money. Now, some of you might be thinking, so I have to go through all this headache for me to only be making $1,150 every month? I will tell you that yes, it is better than doing nothing. And these are the benefits. I will quickly explain them to you. Number one is now that you are now getting this cash flow. You get this cash flow of $1,150 every single month from your property. Now, you can increase your cash flow by trying to reduce your expenses. You can try to do some things to improve the income and decrease your expenses. That is how you can improve your cash flow position. But that is even only in year one. From year two, rents do go up, right? Rents do go up. And even when you factor, when you factor inflation and everything, your monthly cash flow from year two should be higher than your monthly cash flow in year one. Year three should be better than year two. Year four should be better than year three. And you can go on and on like that. So just know that this is the year one. Now, after that, there is also multiple tax benefits that you enjoy when you own real estate. You're going to be getting a lot of things to write off as you maintain your property, as you pay contractor, as you do this, as you hire professionals. Those things can be write off if you have a proper bookkeeping, and you can send your CPA or your accountant all those expenses during the tax season. I typically do it every month, so I don't have to wait till the end of the year before I send it to them. So now also that can now help you to reduce your tax burden right here. This can easily reduce your tax burden right here, because if you pay less in taxes, that means there is more money in your pocket that you can now go back and reinvest. Now, the number three that a lot of people don't talk about is the loan pay down. You're actually buying this property, right, with bank money of $750,000 loan and your own money of $250K, which you got out of your home, right? Now, the tenants are now the one paying down that mortgage for you every single month. And because they are paying it for you, you really don't have to stress about it, because you've done a proper analysis to make sure that, you've account for expenses, account for vacancy, account for property taxes, among other things. You know that, hey, every single month I should be getting this money. So that number four benefit is that you can actually, as the market go up in value, because real estate, they tends to appreciate on the long run, they tends to go up, right? So as the market appreciates, let's say we bought that property for $1 million, right? In year one. Year two, I can tell you the value is not going to be $1 million. Probably will be 1.1. Year three is now 1.2. Year four, 1.3, or 1.35, as the case may be. Plus, as you continue to improve your rents, because commercial property or multifamily like this, they are typically valued based on the net operating income, NOI. Everybody care about NOI. How much is it bringing in after all expenses? That is what people want to hear. So if you do that, if you can increase your NOI, so you are increasing the value of your property. Plus, maybe you're able to add some amenities, some ROBs, we call it ROBs. So, and all those things, you're able to increase the value of your property as well. Now, the last one, which is biggest one, is that you are now leveraging your money. You're leveraging your money, and you are leveraging your assets to buy more property, to buy more assets. And after a few years, let's say 3 years down the line, 4 years down the line, this property has been able to appreciate, you bought it for $1 million, now you worth 1.4 after the fourth year, right? You can now go and free up that money and pay off your $250,000 that you borrow from the bank, right? You can now pay it off. Once you do that, now your cash flow now really, really go up. It go up because now you stop paying this $13,000 HELOC payment every year, rather, right? Now you stop paying that. So, which will help you increase your cash flow position. Now, if you don't want to do that, you can do the same thing again. Refinance or do another HELOC on that $1.4 million property and go through this process again and continue to do a 1031 exchange I mentioned to kick down the can. You keep on deferring the taxes to build your real estate portfolio, to build a larger empire of real estate. So that is how the rich people play the game, and I do want you to be smart with your money as well. If you made it to this point, I say thank you again, and I hope this is the ultimate video that you need to make that smart decision on what you can do with that your lazy home equity in your property. If you want to get my calculator I mentioned again, comment the word CALC and I will send it to you. Of course, make sure you're subscribed to the channel and share this video with anybody you believe this video will benefit, because I know a lot of people don't still know how to get money out of their home and they really want to do something in real estate. So you're going to be helping somebody by sharing this video with them. Now, if you want to get my ebook on rental, how to really build wealth through real estate, I strongly encourage you comment the word rental and I will send that to you as well. It's a PDF that I spent so much time to put together that will walk you through step by step how to actually even buy a rental property. What are the options available to you when it comes to real estate? I appreciate you once again for watching this video till the end. If you are not subscribed already, make sure you subscribe to the channel. Click on that notification bell so I can let you know when I have the new video. Now, if you want to watch this video, next one right here, how to analyze rental property, you will find a lot of value in that video, because like I said at the beginning, most people don't take action because they are confused. They don't know how to analyze a property. But if you can be 2-3 steps ahead of a lot of people by watching that video, you will make smart decisions faster. Thank you so much again, and I will see you in the next one. Bye-bye.